Welcome to the Best of Investing. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm, and Kathryn Harris, CPA of Parati & Karad. Our phone number is 888-912-1190. You're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, which is located 1 hour northeast of San Francisco. The vacations are free, and their only request is a $75 cleaning fee to cover housekeeping expenses. Their website is lighthouse4fun.com. Check them out. The weather is getting excellent. We're approaching summer. You can reach them at 916-777-5511. And today's trivia theme is the Beatles.
All right.
All right? Okay. All right. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. And we're also on television, Comcast Channel 26 and AT&T Channel 99 on Saturdays at noon and Sundays at 6 p.m. And lately, some people have been coming up to not only you, Mark, but me and a couple of other people saying, you know, I've seen you guys on TV.
That's
Where
right.
have I seen you before?
People are watching.
They are watching. Okay, and this segment of the Best of Investing is brought to you by crystalbull.com. Not Crystal Ball, but Crystal Bull, B-U-L-L. And if you've ever wondered why the stock market has big up or down days when new economic data are released, I always kind of wondered that myself. Check them out, crystalbull.com. They show the relationships graphically. Try to put all the puzzle pieces together. Now, Kathryn, right away, you are coming in with some excellent information about college.
Well, it's a topic of conversation. It's been a conversation I've had today just with a client. So when I ran across this article on the internet, and the title is "Don't Go Broke Paying for Your Kids' College," and it talks about
I raise my hand on that.
Yeah.
People in this room are going broke putting their kids
I already am.
Oops, too late.
For my 5-year-old, I'm already that is apparently it's supposed to be my retirement, but
Yes.
it talks about there's this they call it a sandwich generation, with many boomers who are trying to support their aging parents, pay for college, and try to fund their own retirement account. And
Wow.
what they just
forget about
That is
It's a big squeeze.
that you nailed it right on the head. I mean, that is I can dig it deep.
Yep,
That's
yep,
all,
yep,
folks.
that's-
I can
that's
relate
it.
to
I
that.
resemble that remark.
Yeah, exactly.
Yeah.
And we would, in fact, the client I spoke to today was talking about he had his son who is in graduate school, and they were trying to decide. He has entered into a couple student loans right now, and they were trying to decide if his parents should pay it off because he wasn't getting the interest rate that his son is paying on his private loans, which are around 6-7%.
Yep.
So I think that's a great rate of return for me.
Sure.
But then, of course, then he said the downside is that my son owes me money.
Yeah, but if your son's going to be responsible and going to be paying it anyway, might as well. In fact, I remember my student loans were at 3% when the interest rates were 20%. They were just giving
Wow.
students a fantastic deal. You
And
know?
was that all private, or was that all governmental, or was there
Yeah.
private industry in that as well?
I know I think that was just strictly the government back then in the early 80s. So yeah, it was one of those just fantastic deals where it's like even if you didn't need the money, you borrowed it
Well,
anyway.
that's how you would borrow money rather than getting one.
Yeah,
that was
and
at
stick it in the
20%.
bank at 16%. You know. Yeah.
So I love that analogy, the sandwich generation, because it's so true. So, in the Bay Area, you could be making $250,000 a year, which would qualify you to be be a 1%er, right?
Yes.
But like a lot of us, and you and I are both baby boomer age. Kathryn, you're not quite with us yet in that
Not
group, but
Not
But
that.
I relate to having to take care of your aging parents financially, and sometimes there's a sibling or two involved therein, and the incredible cost of college is just unbelievable. And you could be a 1%er and be feeling pretty broke in the beginning.
You know what
Definitely.
we are the sandwich generation now because that's all we can afford to eat.
Exactly.
Bologna sandwich.
And then once you
right.
add in the implications of tax,
Yeah.
because you find that people who make less than the 200,000 often qualify for various credits, but you usually don't get a lot of benefits during that 200 to almost $1 million range. But once you start making more than $1 million, there's
Well, you don't
tax-
care
you
anymore.
Yeah.
It's like
Yeah,
you
you don't
got-
care anymore,
But
but
you're right.
it doesn't pinch you as bad. But
Yeah.
I agree with you that there's a window in there that, especially in the Bay Area, and it hurts because it's almost like a living wage. You're doing well, but it's not like you can going out to dinner every single night and doing
Well, because
wonderful
housing
trips.
here is pretty expensive, so that's a major part of your income.
Yeah,
And
add that to
taxes.
the little list of
Sure.
add housing prices and taxes
And
to it.
sales tax. I mean, here in the Bay Area,
It's
sales
10%.
taxes, are
Yeah.
around 10%.
But you're right. So you make more money, right? If you can, and some of us do. We work harder, we do different things, and we make more money. And now all of a sudden, the grants and the loans that we qualified for to help put our son or daughter through college, now we don't qualify for that. So it's this double-edged sword. It feels like you're constantly swimming upstream with respect to the education part of it.
You do feel bad. And I remember going through college. My parents were reaching retirement age, and my father got disabled. But the criteria to qualify for various grants and for financial aid is such that if you are under the age of 24 and don't have a child, weren't part of the military, you must disclose your parents' income, regardless if they pay or they don't pay, or if they support you or don't support you. So it's one that really you're fighting the battle in any way you go. Sometimes you have parents who've got the income to support you, but it's while they're also trying to, in theory, these are the glory years in the sense where you should be traveling and being able to have no one at home where you can save a lot of your income, banking your income for retirement, and that just isn't the case anymore.
So what is one to do?
Well, this article suggests start saving earlier, which is why I'm already in debt.
Too late.
It is
That
too
ship
late.
has passed.
Well, they suggest is for parents is not to fund your children's college accounts or to fund their college tuition. Have them go out and get the student loans, and then turn around and it does make them maybe a bit more responsible or accountable for the debt. It makes it more real. We live in a real, non-real, tangible society anymore. Cash just doesn't have the feeling. People just think put it on the credit card and it's
Well, also
deferred.
if the parents keep bailing out the kids, and it kind of started. It's too easy, especially when you're when you have like here you've got a daughter, right? And then they give you they back those baby blues. Oh, daddy, I love you.
I spent my allowance already. It's only the 10th. You know? The Army Reserve is sounding better and better every month.
Yes. But there is, and on a completely different topic, is for people who are borrowing from from student loans, is where they get a distorted reality of what's to come 10, 15, 20 years from now. They may hear when they go into a financial aid office, oh, you borrow it and you can pay it back, or you can pay it back based on your income, where it's income based, and hey, after 20 years, you don't pay it off, it's forgiven. Mind you, Edward knows, it may be forgiven, but usually what comes with something that's forgiven is a tax bill.
Yes.
And
Debt
usually by that
forgiveness.
time, the interest that's compounded, the tax bill is darn near close to what you just borrowed for student loans.
That's a good point.
It's
That's a good point. So
It's a way to
cheat the
defer
government.
it, but you can't avoid it.
a lot of things in life like that.
Go, yeah,
especially
well,
for
I'll just
taxes.
die. I'll show you.
That's right.
And guess where they're gonna go?
The estate. They'll come to my grave and pick my pockets. Okay, we're gonna go to a quick commercial break here. The theme is the Beatles. All right. In the late 1960s, one of the Beatles was rumored to have died. Which one? The first three callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. I remember that when that happened. And oh my
We're going to
God.
make Kathryn answer.
I know.
I know a couple of the people's names.
There you go.
I
Okay.
got that, so I can at least give a guess.
Okay. And, okay, so if you answer that question correctly, you win a free 3-day 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. In the 1960s, one of the Beatles was rumored to have died. Which one? All right? Don't touch that dial. The Best of Investing will be right back.
Are you a millennial or a Gen Xer? You're millennial, right? You didn't even know?
I think I'm an X.
Yeah.
MX, not
Wait, what year were you
83.
born? Yeah, that would, yeah.
I think I'm about
college, by the way.
Yeah. '83.
I'm
I
starting-
started off my accounting practice back then.
I'm starting to feel you.
Yeah.
I'm not quite.
She's gonna pass it. She's gonna pass this up pretty soon.
Yeah.
Yeah, when is millennials
I
was
think-
what?
Imagine
92?
the 90s.
Yeah. Because Christian Kimberly are.
That's true. They have been left out of the housing recovery. They don't. And do they give their reasons why, or other than?
They've amassed large debt loads and struggling to find jobs.
Oh yeah.
Which really part of which kind of followed is I wonder where, and I guess that's really more for Rob, was if they noticed, are they finding more and more difficult for people to be qualified with more student loans? Or when they,
work for the company store. Is that so? Did you want to cover something else specifically?
no,
on
I
that?
just brought,
Okay,
let's
let's
go.
go to yours and then we'll kind of go back and forth.
Got some most. I know it's hard to. It's just basically predicting that prices may soften.
And away we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Kathryn Harris, CPA. Always have to say CPA at the end of that.
You do.
It's kind of a title, yes.
I worked really hard for that.
Yes, you did. That's a very hard exam. Practice is 2 parts, audit and theory. Is it still that way?
It is. There's 4
Wow.
parts to the exam.
Yeah.
They made, I think, did you ever try taking the exam?
You know what? I got close on all parts, but I didn't pass any of them. My dad had died 6 months before, and I had to get his estate in order and stuff, and so I didn't have any time to study.
They've made it easier, so you can basically take one at a time.
Ah.
Where you used to have to sit and take all
You
at
young
once.
kids. Don't
Yeah.
know what it used to be like.
Exactly.
Yeah, exactly. Well, and it's funny because I do have my Series 7 license, which is a very hard exam too,
It
but
is.
not as hard as the CPA exam. Okay, the commercial break that we just took, we have the trivia theme as the Beatles.
Mhm.
In the late 1960s, one of the Beatles was rumored to have died. Which one? Kathryn?
I'm gonna guess Ringo.
No.
Darn.
Paul.
Paul McCartney. That's right. Okay.
Paul is dead.
It's okay. Yeah,
It's not true.
it wasn't true. Yeah, what they had, it's the White Album, the one where they're walking across the street, and there's all kinds of hints, like
He wasn't
40
casting a shadow.
something. Yeah, exactly. And he's the only
Oh
one.
my.
He's the only one barefoot. And then there's a little license plate that says like 49 if. Like if he had lived, he would have been 49. There's all these kind of fun little things because they Beatles.
Oh,
just-
did they play on it?
They
Is
played
that
on
what
it,
was?
exactly.
Okay.
I don't know what the rumor started, but
Just
they,
weird.
yeah, they just played on it. Mark, you got an interesting article for it. Share it with us.
Yeah, so last week we were talking about how, real estate prices are up, inventory's down, unit sales are up, the housing market looks strong and it's tight and prices are, going up, and what's going on. And then there's this article from First Tuesday, which is a California-based real estate educational organization, and their site, which I subscribe to, has a number of interesting articles every week and throughout the year. And I don't always agree with many of the articles they post. I think they have an interesting slant, and I'll share a little bit with that with you. But it's predicting that prices are going to top out in the second quarter, which we're in right now, of 14, and that we could see, and this is a prediction for California as a state, not necessarily the Bay Area market, because we know we've got micro markets in the Bay Area that have other things going for them that would preclude this from happening. But they're predicting that we are in a mini bubble, in that between the second half of 2014 and 2015, that they're projecting, based on these graphs and charts that I've brought with me here
In color too.
in color, that prices are going to go down between 10 and 15%.
Oh,
That's
wow.
pretty large.
Yeah, I was gonna say, I mean, we had, what was it, almost, they said about a 20% increase, so I could appreciate a little bit of softening just as the inherent growth, but
Well,
10,
they're
15 is pretty
They're
substantial.
basing it on two graphical, two charts. One that is a California buyer purchasing power index as it relates to home prices, and apparently the purchasing power has dipped below their graphical representation of 0. And when you go back over the last 20 years, every time that happens, there has been a decrease in prices. That's the first chart. And then the other chart they show is basically a tiered pricing chart with the median, the mean price level as a straight line. And they're basically saying that prices have topped out, and based on predictions for mortgage rates and average wages and income, that we're set for seeing a correction in prices. Now, again, I think we all know that there's a lot more variables involved in the real estate market, including things like inventory and demand that's fueled by certain sectors of wealth, like the tech sector. But it gives one pause, and certainly someone like me who's in the lending business, I need to be aware of that, because certainly you don't want to have blinders on, because as we know, real estate doesn't always go up in value. So here's one of the naysayers, and it's a fairly well-known naysayer, and they're saying that today's pricing is the tail end of a mini bubble induced by short-lived speculator interference. Now, that statement right there, the speculator interference, First Tuesday has had articles now for the last probably year and a half blaming the run-up in prices on speculator activity, people buying up homes for speculation to buy, fix and flip, etc. I don't necessarily agree. I always believed that the price decline that we experienced after 2007 and 8 went too far. It went so far below replacement cost that, economically speaking, it was impossible and unsustainable mathematically for home prices to remain as far below replacement costs as they did,
unless everybody moved out of California.
Right, and so there's a rubber band effect to a good portion of the increase in prices, and then that coupled with the pent-up demand for new housing and the people who are living at home and the increase in the population, all those things that factor into it. I tend to think that they're overstating the influence of so-called speculators. I don't call them speculators. I call them real estate investors, right?
That's what they are.
I really don't. But anyway, it's an interesting take. So again, First Tuesday, based on their fancy charts and graphs, are predicting that prices in California, on average, may see a decline between 10 and 15% in the next 12 months.
I'd be curious to see what areas of California have had substantial increases over the 2013 year, because a lot of it
A lot of
seems to
the
be
low
very
ones, like Stockton and
were the ones that had the
yeah, because they dropped so low. But I like your analogy, or not your analogy, your term of investor instead of speculator. To me, a speculator is somebody who buys some prospecting tools and goes and digs somewhere hoping to find something.
He's going in blindly.
Yeah, exactly.
Not.
Right, speculation connotates irrational exuberance or something that we're just stupidly buying, and speculating was what was happening in 2003, 4, and 5, where you bought a house at full retail knowing that it was going up 1 or 2 percentage points per month, and all you had to do was just wait 6 months and turn around and sell it, and basically arbitrage your way into wealth, which that was clearly
I long
not
for those days again. No, actually, that's not a good thing. It's like the Silicon Valley when you had .com. I mean, bubble. It was ridiculous. Some of the rents were going up so much that it's, as a landlord, you didn't really like it that much because you knew it had to come down. It's better.
Well, that's
to
why I'm
just
curious
slow
about
growth.
San Francisco. San Francisco, they had, I think, exceeded New York City as the least affordable city in America.
Yeah.
So I can see
Thanks
that.
to our tech titans.
Yeah, exactly. So it's kind of it really is it usually is very, the least in the Bay Area is very strongly correlated to any bubbles in the tech industry, because usually with the tech industry are people who are coming in with high compensation or really strong stock option portfolio.
Well,
So if
say
they
there's
were
not
to
a
go
VC
public.
money. VC
Well,
money coming in.
And look what happened with Twitter.
Exactly.
So Twitter, the 6-month expiration for holding the stocks
yeah.
expired a couple of weeks ago.
Yeah.
And we all read that, well, the Twitter stock went down 18% because of the sell-off, but which was noteworthy. But what was more noteworthy was all of that new, fresh billions that were minted for all of those people who did sell their interest in Twitter stock. And of course, there was a comment in the article about how the local high-end real estate brokers in Marin and San Francisco were rubbing their hands with glee because they knew there were going to be a fresh batch of home buyers looking at their high-end homes. And if you look at things
kids
like
with skateboards.
Yeah,
like,
exactly.
pick up a Marin magazine and flip to the back and look at all the homes they have listed between $10 and $25 million
Yes,
with their glossy photos. Those are aimed right at those newly minted Twitter millionaire and billionaires.
Yes.
Good
Though
luck.
that
Happy
stock
buying.
though those stock went down 10-15%, they bought that stock for $1. And what was it selling for? Do you know?
Yeah.
$20,000-$30,000 in stock. So they made out very well.
They did.
Amazing. Okay, we're going to cut to our second commercial break here. Before we do, we had another trivia contest. This was for the Westin Barossa, which is located on the riverbank in the heart of downtown. The Westin Barossa Napa is within walking distance to more than 15 Napa Valley wine tasting rooms. Replenish your spirit and sense of fun this season at the Westin Barossa Napa and experience the bloom of spring, the peak of summer, the autumn harvest with a cozy ambiance of winter and luxury. With 180 guest rooms that are offered with unique packages, there's nothing to hold you back. Visit www.westinnapa.com, a member of Starwood Hotels and Resorts. Very nice place.
Sounds lovely.
Very lovely. And here was the trivia question. Over 30% of adults have never done this. What? And the answer was written a check. Can you believe that?
No way.
Isn't that amazing?
That is mind-boggling.
And let's see, our winner was Jake from Walnut Creek. Congratulations. Okay, now we're gonna go to our second commercial break. Again, the theme is the Beatles. Who was the drummer before Ringo Starr, sometimes referred to as the fifth Beatle? The first three callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Who was the drummer before Ringo Starr, sometimes referred to as the fifth Beatle? Make sure to include your name and your email address. Speak slowly, please. Spell out your email one letter at a time. And don't touch that dial. When the Best of Investing comes right back, we've got some interesting emails for our co-hosts.
You don't know?
No, are you kidding me?
Oh, you don't know that one? Okay.
He's the guy that, can you imagine? I mean, he got replaced. He got kicked out of the band.
Yeah.
Ringo gets hired, and then they just completely explode in fame, never before seen in the history of mankind. And this poor fucker's going,
And
that
Ringo
could've been me.
was a terrible drummer.
Oh my God.
He really was.
But he was a better personality and character. It was a good,
apparently, yeah.
It fit the group.
yeah.
I always liked Ringo myself, but
yeah, he should be drummer.
Oh, that's fun.
yeah. In fact, on the
So here's my question is, did he get other royalties? Did he
that's
get
fine.
royalties?
I don't think so.
Oh, that's pretty.
That is also known
that
as
is
the
a
unluckiest man in
Exactly.
the world
Yeah.
in the 1960s.
That is a hard. I imagine some still today.
Yeah.
I think you'd be
They did a,
nice royalty
documentary
checks
on
still.
Yeah. There
You
was
better
a.
be a guy of faith who just let it go, because if you're not,
Well, that reminds me of the story of the Buddy Ebsen story.
Yeah.
He was supposed to play the Tin
Tin Man,
Man
yes.
in The Wizard of Oz. He was the
Right.
original person who was chosen.
Correct.
And because they were using a certain type of paint to
Yeah.
paint him,
That's right.
he got ill.
Yeah.
He ended up in the hospital,
He almost
and they
died.
had to replace him with
Yeah.
somebody else. They changed the makeup.
Yeah.
And to the day he died, he felt that he had gotten cheated, literally in life, because of
Oh,
when
he
his
still made
his
himself
entire
famous for criminal.
career. He did,
But-
but he would have been. He believes that he would have been much more successful and.
I mean, who even remembers who played the Tin Man, right?
exactly. Well, part of
Yeah. But it's funny talking about Ringo on the song back in the USSR, I think it was, or Revolution, one of those two. Ringo couldn't get it right, and so Paul McCartney plays the drums.
Oh, is that right?
Get off those drums! Let me play them.
Imagine if there's a little resentment who
Probably.
gets all these proceeds and benefits from
Yeah.
as a drummer you can't do it, right?
Ready?
Yep.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Humph and Kathryn Harris, CPA. When we cut to the second commercial break, we asked this trivia question about the Beatles. Who was the drummer before Ringo Starr, sometimes referred to as the fifth Beatle?
My question is, did he get any of the royalties? Did he?
You know, I don't think so. But
Pete
who-
Best.
No.
No?
Pete Best.
Pete Best. Oh, okay. All right.
No.
I was close. I had the E's right.
Yeah, you should just said best. Okay.
Like best of investing.
That's right,
Yes.
exactly. Anything to do with best is the best. Okay. Kathryn, we received an email here that's right up your alley. It says, when looking for a CPA firm, should I choose one that charges by the job or by the hour?
It really comes to your comfort level, but at the end of the day, I've come to find out that really, at the end, it usually washes out to be about the same price. People who are charging by the hour, it's usually if you've got a more complicated return, it's because you've got more forms that have to be filled out, and it takes more time. So people who are going to be charging you by the form is going to be charging you more per form.
Which will still take more per hour.
Which takes more per hour. They built into how much time it takes to complete a form. So their form, the amount they charge per form is going to be higher or more.
But you're not allowed to charge like performance based, are you?
You're not allowed to charge performance based, which means you have an ethical CPA.
Yeah, there you go.
Although I've done both. So I have a CPA that obviously charges by the hour. Not obviously. He charges by the hour for consulting questions, what I call it. But there was for our mortgage pool fund, I was actually getting competitive bids on fixed price for doing it because again, I wanted to save. I wanted it to be as cost effective for the fund. And so for its first return, I remember calling a bunch and getting price bids. So I guess.
But you can't do it performance based. Like if we get you a larger tax refund, we'll give you. Yeah.
Exactly.
Invent something.
But I imagine you weren't getting from the same CPA firm. It's usually a CPA firm has a policy of we just charge by the hour, or we charge per the forms, number of forms that are filed. But I would be surprised if they're pretty comparable. I mean, usually the ranges are within depending on the size of the individual or the form. Or
How does Karate and Karate do it?
we charge by the hour. There we go. And so, depending on the case, though, we will work with somebody. If it's a flat rate, we can work with them and have a flat rate.
Do people call you and ask for a not to exceed price?
Not for tax returns. We are a full service. So we do not just that. We also do bookkeeping services and test services. Bookkeeping services we also do on an hourly basis.
And a test would be.
A test is usually where we get to not to exceed in the fixed prices.
You might have to explain it to the audience.
So test services are for clients. Usually it's going to be for nonprofits or businesses, S corps, C corps, LLCs, limited partnerships, where they have to have an audit or review or compilation, and it's usually governed by something in a loan document. It may be a law that requires it. We do.
I mean, they don't trust their own clients to
Well,
compare their Quicken or books.
Yes,
or
exactly. Please let me borrow money from you. I have all of these assets and no debts.
Exactly. See, it's on this napkin right here.
Exactly. And the same thing for, really I like to talk about as nonprofits is you hear in the news how there is misappropriation of
Oh my gosh,
nonprofit
all the time.
assets. And great thing that California has implemented is if you have a nonprofit that's got more than $2 million, it has to be audited. And you should ask that. When you look for donations to nonprofits, is see if they have an audit. Look at their audit. Look at their tax
That's a really good point because a lot of times people who are on the board of nonprofits, it's usually just they're doing it as a favor because they just love the organization. They're not getting paid this nice big salary, so they kind of just exactly. So they're just putting in their hour a month or whatever period, and they're just like, well, we just trust whoever is in charge. And boy,
there
really
was a recent article about a gentleman who they trusted their executive, and the executive gave them bank statements that weren't exactly accurate and got away with a lot. And the board, you have to understand that for nonprofits, the board is fiduciary. I can't say the word.
Fiduciarily.
That is a hard one.
That is a tough one, yeah.
Fiduciarily responsible
Wow.
to some degree. I mean, it's got to be egregious for them to really be
Yeah,
responsible.
but can you imagine being on the board like, hey, Joe, you want to be on the board of this thing, this nonprofit, because we know you love the symphony as an example, right? And then suddenly, oops, you're slapped with a lawsuit because the bookkeeper stole a bunch of money.
I was just coming to the board meeting.
Yeah, exactly. I was having fun.
So we do that type of service as well, and we do it for nonprofits and for private as well, for private industry.
Okay. What name of your company is?
It's Parati and Karad. I'm Kathryn Harris. I am the test manager, but I also work in tax as well. I can be reached at 415-461-8500.
And your office is located?
We're in Larkspur.
Okay, pretty centrally located.
Pretty centrally located. Most of the partners in the firm are all from Marin, born and raised. We don't really go very far. We're CPAs. We're very. How dare you ask me to go do something? They have our conventions in Las Vegas for a reason. They know we're not going to bet. They have us in like the farthest hotel possible because we're going to lose money. No one dare go. I won like $80 and I walked away.
There you go.
Like,
Smart.
Yes.
That's right.
That's funny.
But it's kind of nice because you're close to the Larkspur Ferry. You're not far from northern California. You know, I mean, like Novato, and not too far from San Francisco. So
it's a good location.
Come visit you.
Yes.
Very good. Okay, Mark, we received an email for you. It says, do any of the loans you provide have prepayment penalties? Good question.
Well, no and yes. So let me explain.
Yeah.
So
You got to pick one, yes or no?
Well, in the private money lending industry, some people refer to it as the hard money lending industry, the most common form of a prepayment penalty is not really so much a prepayment penalty as it is a minimum interest guarantee. And what that means is that, and again, this is not on every loan, because we do a lot of loans now that have zero prepayment penalty. You pay it back in 6 days or 6 months, and there's no penalty other than the cost of the loan itself and the interest rate on a daily basis. Now, the minimum interest guarantee is something that we do oftentimes with individual notes that a private individual might fund directly. And oftentimes, individuals who have been funding loans on a regular basis, they want to make sure that they don't get their money back too quickly, and they'll say to me, Mark, I'm interested in funding that loan, but what's the minimum interest guarantee? And the question they're asking me is, how many months of interest is the borrower willing to promise to pay before he'll pay back that loan? Now, years ago, 6 months used to be a pretty common minimum interest guarantee. What that means is that if you paid off the loan in 5 months, you would still owe an additional 30 days interest. In other words, you're promising that lender that he's going to get at least 6 months worth of interest on that loan he's funding. Nowadays, thanks to competition and the fact that now there's more and more and more private capital has been coming into the private lending industry, that coupled with the fact that there's more mortgage pool funds out there, like our growing mortgage pool fund, which offers loans with no prepayment penalty, that 6-month minimum interest guarantee has been back down to 4 months and sometimes 3 months. So it really depends. So we'll get a call from a borrower, and depending on the loan scenario, he may say, look, I'm going to buy this property, and it's going to take me 8 months to remodel it because it's a pretty significant remodel. And we might make him a loan of 70% of the acquisition price, and because we know he's not going to pay it back for the better part of 8 months, maybe a year, we'll say, hey, are you willing to give us a 6-month minimum interest guarantee? And if he says yes, what that will allow me to do is to show that funding opportunity to a greater number of people, a bigger audience of people, because I do have note investors in my database who basically say, don't call me unless I can get a 6-month minimum interest guarantee, because they don't want to go through the trouble, the time, and quite frankly, the stress of deciding to fund a loan if they're going to get paid back in 2 or 3 months, because it's just, you don't really make that much money on that type of short-term loan if you're directly funding it. Now, our mortgage pool fund, on the other hand, people who invest in our fund, their money's working 24/7, and our fund loves to make loans that the borrower only wants it for 2 months, or maybe he thinks he's going to flip this property in 3 months. Because we charge not only interest, but we charge points, origination points. At 1 point equals 1%. In a typical loan, we might charge 3 percentage points of the amount funded as an upfront fee from the borrower. Paid not upfront, paid with when the loan closes, but half of that goes into the mortgage pool fund as income, and so it kind of boosts the yield that the shareholders earn. So if I take, if I can revolve the same dollar 2 or 3 times in a year, as opposed to making a 12, 24, 36 month, I can actually get a higher yield for the fund by making lots of short-term loans where the fund shares in those origination
And
fees.
we've talked about this before, that I don't know of any other fund out there that shares the points. Usually the person
that's usually the
running
fee to.
That's right, exactly. So
It's
it's really
rare.
it's very rare. So
It's rare.
it's pretty awesome, because then that means your interests are aligned with the fund, which is very important because
Well, we designed it that way. We wanted, when we worked with our fund consultants to design the Pacific Private Money Fund last year, we said, well, our typical loan demand is for short term, and we're seeing more and more people coming up to us saying, hey, I only need money for 60 or 90 days. That's particularly true on a very, very short term bridge loan that someone might need to help them close on a property, but they've got bank financing lined up, 60 to 90 days later. This way it allows the fund to benefit from making these short-term loans. It's not just me, the broker, being able to get all of these origination fees, and the fund only gets the interest rate.
Okay, so if people want to get a hold of you to either borrow money or invest money, and when we come back from the break, we're going to explain how people can earn over 8% and give us the deal
Yes, I
of the
want to
week.
know how and when I can invest.
Yes, exactly. How do people get a hold of you?
So Pacific Private Money, we're located in the San Francisco Bay Area. Our number is 415-883-2150. Again, that's 415-883-2150. Or go check out our website at pacificprivatemoney.com.
All right, we're going to cut to our third commercial break. Here's the trivia question. Again, the theme is the Beatles. I got to do my singing voice here. What is the title of this song that starts with, I give her all my love, that's all I do? Okay, I'm the sixth Beatle.
I'm the
Okay.
blank face.
Yeah, blank face. Okay. The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. What is the title of the song that starts with, I give her all my love, that's all I do? All right, don't touch that dial. The best
You
investing
sing that in the shower, don't you?
every day. Actually, that would be a good song to sing to my wife, wouldn't it? Okay.
Yeah.
Yep.
Don't touch that dial. The best of investing. I'll be right back. Yeah, my wife loves to hear me sing 10 or 15 miles from here. Is that camera on?
You know the song?
Has
No.
that been recording me
That song?
singing?
Yeah.
No. In fact, I shut it off when you started singing.
There you
Robert,
go.
I haven't seen Robert Spinoza.
Oh,
The
no.
Spinmeister, he hasn't been here.
Spinmeister.
He was here a few weeks back.
He was.
Yeah, we recorded 2 shows a month ago, and
Yeah.
he hung out with us. I'm getting all his. He's like one of the most prolific Facebook posters. I don't know if you're friends with him on Facebook. He's constantly posting house listings, and even though he's a funding guy, he's always going to these open homes
Oh.
because he'll be the guy handing out the mortgage broker flyers.
I
It's
never
good. It's
joined
good.
Facebook, and now I didn't do it
You
because I was lazy, and now I'm like,
Facebook
It's annoying.
It's an annoying waste of time, and I
Yeah.
hate it. But I have to.
Yeah.
Well,
So I use it.
I'm happy being on it too. I did LinkedIn.
Well, our
Here we
kids
go.
are, and you're,
We'll see, guys.
well, and I don't know what your kids are, you're young and still young, but my girls don't do Facebook, they do Instagram.
Yeah,
That's what all the tweens do, they don't do or Snapchat.
It's what it's become is. It seems like it's gone just even in emails everywhere.
Yeah.
Advertisements.
Yeah.
Ads.
Yeah, I spend 20 minutes a day deleting emails. It's just.
Because you bought that one thing from them 10 years
Yeah.
ago,
Yeah,
and they needed your email address to complete the transaction.
well, because I do email blasts, because I'm one of those guys,
Because-
they all put me on their list.
Yeah.
So I'm on everybody's list.
8 minutes, 11 seconds.
8 minutes, 11 seconds.
All right.
All right.
Okay. Welcome back to the best of investing. I'm Edward Brown, your host. The Beatle. I'm the 6th Beatle. No. We got Mark, Han, co-host, and Kathryn Harris, CPA.
Not a beetle.
Not a beetle. Okay. Just a mosquito. No. Sorry, just teasing about that. That came from Gilligan's Island. The mosquitoes visited the island. Okay, what is the title of this song again? Talking to the Beatles here. It starts off with, I give her all my love, that's all I do. What's the name of that song?
You stumped me.
And I love her, and I love her. Okay. Oh, we just get too romantic here on the show. Of course, you know, if you weren't here, it would just be the guys. I wouldn't be doing this.
I think you would be singing that song
Oh,
all the entire time.
He sings it to me.
Okay.
Yes, exactly.
You sometimes when you can't sleep at night, he calls me up. Edward, please sing me a lullaby. Boy, we have too much fun here. I was saying off the air that my wife likes to hear me sing 10 or 15 miles from here. But okay, so Mark, we keep the audience in suspenders here about how to earn 8.5+%. How do people do that?
Well, we started this show by talking about how us boomers are called the sandwich generation because we're getting squeezed on both ends. We've got a lot of us have aging parents that we're taking care of financially, and we've got kids going to colleges that are just unbelievably expensive now. What, $50,000 plus per year for just about any.
Now, is that the tuition or is that?
That's just for the books.
Yeah, exactly.
Just for the books, yeah. Well, yeah, and don't forget the allowance and all the other stuff. And they got to go to a concert every now and again. My daughter's going to college out in Southern California, and I keep seeing her Facebook posts from Vegas. It's like, really?
And
That's
she doesn't.
what
And
I'm
you mean she doesn't go to UNLV?
Yeah.
Yes, exactly.
But so those of us in the boomer generation, I mean, let's face it, most of us are not on track to retire successfully because we've just gone through this 10-year period where our stock returns. We're lucky if we're even adjusted for inflation with 10 years ago from our stock portfolios. And so, what's a person to do when you've got zero interest rates at the banks, you've got CD rates and bond rates that are just ridiculously low, and you've got a stock market that many believe right now is maybe due for a correction or at least maybe poised to provide disappointing returns for the next couple of years going forward. In fact, there was an article in Forbes magazine that predicted, and this was a noted stock writer who predicted that we might see in the next 10 years some fairly disappointing average annual stock returns based on price earnings ratios and other factors. So if
you won't see the rate of return that we had in 13.
So if you believe that to be true and you're wondering what's a person to do to diversify their savings portfolio and to add some investment options that pay higher rates, we've got we did a show for 6 months earlier in the year, Edward and I, called Mortgage Investing 101. And in fact, the website's still up, and there's still about a dozen or so podcasts that we would spend an hour talking about mortgage investing. And mortgage investing, we at Pacific Private Money, we offer two programs. Our primary program is the Mortgage Pool Fund, which is paying about 8.5% right now for shareholders, and that fund is used to make conservatively underwritten loans to real estate investors and other borrowers who don't qualify for bank financing at 70% loan to value and below. And the second way is to buy or invest in individual notes. We happen to have actually too many of those investors at Pacific Private Money right now. They're fighting over the loans that we make available, but which is why we encourage most people to strongly consider the Pacific Private Money Fund, just because individual notes now, I'm talking about quality individual notes. You can find really risky individual notes that some brokers out there are putting together where it's 100% financing or super high percentage financing, or maybe it's a rehab loan or something like that. And we're not doing that at Pacific Private Money. We're making loans based on acquisition price, and we're not going over 70%. We're letting the people who have their own capital to contribute. We're not doing loans based on future value. We're not doing speculative loans.
Which is the reason why the default rate is extremely low.
Well, we've done nearly 700 loans since 2008. We've only had 2 foreclosures. That is so far below even conventional bank foreclosure rates. It's just ridiculous.
And I imagine you guys lose any money on those deals?
No, neither the
So,
investors in
you-
those notes did not lose any money. So no investors has lost money with us, and we've been doing this since 2008. So Pacific Private Money was started as a result of the market crash and the fact that the banks stopped making certain types of loans, most notably loans to real estate investors. They really stopped making those loans to people who were buying rental property or flip property.
You know what I think is the really impressive part is not the fact that, okay, he's been around since 2008, because you go, well, that hasn't been long enough. But that's not the important part. The important part is he's done 700 loans.
Yes,
Right?
and I think, and how conservative you've been. I mean, you guys aren't rushing. You have the
Exactly.
interest of your investors at hand, and that is really important. What happened in 2003, 2004, 2005, banks didn't have the interest.
Correct.
They were
Yeah.
loaning
Robo
and
writing,
exactly, so that they could get those loans closing, could get those closing costs.
That's it.
And you guys aren't taking that. You're not taking on those risks. You're not.
Well, no, he's got a fiduciary duty with the fund.
So the
Exactly.
fund again, it's paying over 8%. It's designed to pay between 8 and 9% in the San Francisco Bay Area, which allows us to loan money out at a very competitive price, and that's one of the challenges. I mean, there are hard money lenders out there who are making loans at 12% and 5 points, but the types of borrowers they have, that's a pretty high risk profile loan. It's very difficult to achieve that loan, that type of loan today in the Bay Area if you're working with borrowers who are sophisticated. We like to work with sophisticated borrowers who
It's like buying a
Okay.
penny stock.
Right,
Well, yeah,
so-
that's
So
exactly.
9 and 10%, even 8% oftentimes might be a more competitive rate in order to get really a high quality, low LTV loan with a very strong borrower. In fact, we make loans to A-paper borrowers, and many people listening out there would go, why would they ever pay 8 or 9 or 10%? Well, because it's fast money, it's a lot easier to get to the banks, and our regulations are a lot different. So again, for more information, contact us at Pacific Private Money. We can send you a prospectus on the Pacific Private Money Fund. Call us at 415-883-2150 or visit our fund's website. It's pacificmoneyfund.com.
Okay, we're going to cut to our thoughts for the day here. The characters Bert and Ernie on Sesame Street. You know where they came from? Bert the cop and Ernie the taxi driver in the movie It's a Wonderful Life. And in England, the Speaker of the House is not allowed to speak. Personally, I think this should apply to in the U.S. too,
Absolutely.
amongst all the politicians. All right,
Yes.
Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Good.
You're so good, Edward. You ought to go on radio.